Home insurance is one of those things almost everybody has, but very few people truly understand it. Most homeowners sign up for a policy when they buy a house, pay the premium every year, and never ever look at it again until something goes wrong. And when that happens, the confusion becomes painfully obvious. People are shocked when claims are denied. They're surprised when payouts are lower than expected. Finally, they don't understand why certain things are covered while others are not. The problem isn't that home insurance is intentionally evil or broken. The problem is that home insurance is written in legal and technical language while homeowners are living in the real world. This video exists to bridge that gap. In this first part, we're going to focus on what home insurance actually is, how policies are structured, and what each core coverage does. No scare tactics, no selling, just clarity. Section 2. What home insurance really is and what it is not. At its core, home insurance is a risk transfer contract. You are transferring the financial risk of certain large losses from yourself to an insurance company in exchange for a premium. That's it. Home insurance exists to protect you from major, sudden, and unexpected financial damage. It does not exist to fix old or worn-out materials, act as a maintenance plan, upgrade your home, pay for issues that develop slowly over time. This is one of the most important ideas to understand. Insurance is designed for sudden and accidental losses, not gradual problems. If something happens all at once, like a fire, storm, or burst pipe, insurance may help. If something happens slowly, like wear and tear, rot, mold from long-term moisture, insurance usually will not. Once you understand this distinction, most claim outcomes make much more sense. Section 3. How home insurance policies are structured. A standard home insurance policy is not one big bucket of money. It is broken into specific coverage sections, each with its own purpose, limits, and rules. Most policies follow a similar structure, usually labeled Coverage A, B, C, D, E, or F, for example. Each one protects a different type of risk. Understanding these sections is the key to understanding how home insurance actually works. Let's walk through each one. Section 4, Dwelling Coverage. Coverage A, Rebuild Cost versus Market Value. Coverage A, also called dwelling coverage, is the backbone of your entire policy. This is the coverage that pays to repair or rebuild the physical structure of your home if it's damaged by a covered event. This includes the roof exterior and interior walls, foundation framing, built-in cabinets, plumbing and electrical systems, permanently installed fixtures. Here's the most important thing most homeowners misunderstand. Dwelling coverage is not based on your home's market value. Market value includes the land location, school district, neighborhood demand. Comparable sales insurance does not care about those. Insurance only asks one question: how much would it cost to rebuild this house from the ground up today using similar materials? That number is called replacement cost or rebuild cost. This is why a $600,000 home might only need $420,000 in dwelling coverage, or a $300,000 home might need $500,000 in coverage. Construction costs fluctuate due to labor shortages, material prices, local building codes, inflation. If your coverage is too low, you may be underinsured, even if your policy looks fine on paper. Many policies include something called extended replacement cost, which provides an additional cushion, often 20% to 50% extra, if rebuilding costs exceed expectations. This feature can be critical after large-scale disasters when construction costs spike. Section 5. Other structures coverage, Coverage B. What's included and what's not coverage. B protects structures on your property that are not attached to the main house. Common examples include detached garages, storage sheds, fences, gazebos, detached workshops. This coverage is usually set as a percentage of dwelling coverage, commonly around 10%. So if your dwelling coverage is $400,000, you might have $40,000 for other structures. Here's where people get caught off guard. That default amount may not be enough if you've added large detached buildings, expensive fencing, custom structures, a detached guest house. Most homeowners never review this section until after something is damaged or destroyed, and by then it's too late to adjust. Section 6. Personal Property Coverage. Coverage C. What's covered inside your home? Coverage C protects your personal belongings. This includes furniture, clothing, electronics, appliances, tools, kitchen items, decor. Essentially, if you could turn the house upside down and it would fall out, it's personal property. This coverage is usually set at 50% to 70% of your dwelling coverage, but the exact amount matters less than how items are valued, because not all policies pay the same way. Section 7. Actual cash value versus replacement cost. Critical difference. There are two main ways insurance policies value personal property. Actual cash value, ACV. Actual cash value subtracts depreciation. If your TV is 5 years old, insurance pays what that TV is worth today, not what it costs to buy a new one. After a major loss, ACV payouts can be shockingly low. Replacement cost value, RCV, replacement cost, pays what it costs to buy a new, similar item today. This option usually costs more in premium, but the difference after a total loss can be tens of thousands of dollars. Many homeowners assume they have replacement cost coverage when they actually don't. High-value items like jewelry, artwork, collectibles, firearms often have special limits and may require separate endorsements. Section 8. Loss of use coverage, Coverage D. Living expenses. After a loss, loss of use coverage applies when your home becomes unlivable due to a covered loss. This coverage helps pay for temporary housing, hotel stays, rent, increased food costs, utility differences. The goal is not luxury, it's maintaining a reasonable standard of living similar to what you had before. Loss of use coverage is typically capped at a percentage of dwelling coverage, often around 20%. This coverage becomes extremely important after fires or severe storm damage, when repairs can take months. Section 9. Personal liability coverage, Coverage E, protecting yourself from lawsuits. Personal liability coverage protects you if someone claims you caused bodily injury or property damage. Examples include a guest slipping and falling, your dog biting someone, a tree from your yard, damaging a neighbor's property, accidental damage caused by your family members. This coverage pays for legal defense, settlements, court judgments. Legal costs alone can be financially devastating without liability coverage. Many experts recommend at least $300,000 and often more. This is one of the most valuable coverages on your policy and one of the least expensive to increase. Section 10. Medical payments coverage, Coverage F. Small claims, big purpose. Medical payments coverage handles small medical expenses for guests injured on your property, regardless of fault. This coverage exists to handle minor injuries quickly, reduce the likelihood of lawsuits, resolve issues without legal escalation. Coverage limits are usually low, often between $1,000 and $5,000, but strategically important. Section 11. Named perils versus open. Perils, how coverage is triggered. Insurance policies don't cover everything. They cover damage caused by specific events called perils. There are two main approaches. Named peril coverage only covers losses caused by events specifically listed in the policy. If it's not listed, it's not covered. Open peril coverage covers everything except what is specifically excluded. Most modern policies use open peril for dwelling coverage, named peril for personal property. Understanding which type applies helps explain why certain claims are denied. Section 12. Common coverage, limits and sublimits. Homeowners. Many homeowners assume their coverage limits apply evenly across everything. They don't. Policies often include sublimits for jewelry, cash, business property, electronics, water damage. These limits can dramatically reduce payouts if not addressed ahead of time. Section 13. Quick recap. What home insurance covers at a high level. At a high level, home insurance protects the structure of your home, other structures on your property, your personal belongings, temporary living expenses, liability and legal exposure, minor medical payments, but how much it pays depends entirely on policy structure, coverage limits, valuation methods, exclusions. In Part 2, we'll cover what home insurance does not cover, how claims really work, why premiums rise, and how to avoid the most expensive mistakes homeowners make. If you want to truly understand home insurance, Part 2 is where it all comes together.